Economics and Public Policy at the Blavatnik School of Government. And jointly, they form the leadership of a team working on levelling up in this country. So we are, in very fine company, and we couldn't really have chosen better thought leaders to help us try to work out how we can restructure the failing companies that we're going to be having after the pandemic and rebuild the depressed regions in the UK. Now, the structure of the conversation, as with the last conversation, is that Colin and Paul will give us 10 minutes each to set the scene, and then we'll go into questions. You have an Ask a Question button at the bottom of your screen. Please do keep the questions coming in. We had some very good ones last session. And with that, over to you, Colin. Tell us about the paper.
Okay, thank you very much indeed, Cameron. There are a lot of things that we could talk about in relation to the levelling up agenda, but there's one that we're going to focus on particularly today, and that's the importance of the financial system in achieving successful levelling up. Now, the starting point for this is to understand that Britain once had one of the finest financial systems, in particular banking systems in the world. Indeed, the reason why the Industrial Revolution basically started in the UK was because of its banking system, a very dispersed local banking system, which was very engaged in funding companies around the country. But there was a problem with it. It was exposed to failure, and many banks failed. And as they failed, then the Bank of England consolidated them, and they shifted their headquarters to London. So that by the time we come to the end of the 19th century, we find Britain has 5 major commercial banks and little else. And that persisted through much of the 20th century, and it solved a problem in terms of failure of banks. There wasn't a failure until the 1970s secondary banking crisis, but it also did a second thing. It destroyed the financing of the British corporate sector. And in particular, in that process of centralizing banks in London, it also gave rise to a second substantial problem that we're still living with today, namely a high degree of regional disparity between a growing, prosperous southeast and an increasingly declining rest of the UK. Now, that is the basis on which we need to think about how can we reverse what has now been a problem for more than 100 years in the UK. And to understanding that is to appreciate that what is required of the banking system is to be able to undertake what is a key component of its functions, namely to be able to finance long-term investment by, in particular, small and medium-sized enterprises. Those are the ones that are particularly dependent on banks because they cannot, in general, access capital markets more generally. And it's the area where the greatest deficiencies arise. Now, this problem has been given added significance by the recent pandemic, because what we've observed is that the government has bailed out a substantial proportion of the UK corporate sector, in particular small and medium-sized companies, and in particular in the depressed regions of the economy. Now, when the furloughing scheme comes off shortly, then the UK faces a real crisis in terms of the potential of a large number of failing businesses. It's estimated that there might be about £100 billion of loans at risk of failure, of which around about 30 billion or so is associated with government funding. Now, to restructure that, one needs to have a very engaged financial sector, and in particular banking sector, that can separate out those companies that have a real prospect of turning round and growing again from those that basically have to be put into insolvency or into bankruptcy. And that's where the failure to have a really engaged banking system is going to be revealed to have a serious price attached to it. But more substantially than that, there's also an important function in terms of addressing the regional disparity. And to be able to do that, it's important to recognize that the private sector cannot solve this problem on its own. In essence, we have a multiple equilibria problem. We've got some parts of the country that are booming, others depressed, and shifting from one equilibrium to another is something that needs a coordinated policy to achieve it. It's not something that the private sector can do without the assistance of the public sector. But likewise, it's something that the public sector cannot do on its own, because there isn't a clear way of solving the problems that exist at regional levels. We need a lot of innovation. We need a lot of experimentation. That's something that one doesn't typically associate with central government, but it is something that the corporate sector routinely does. So we basically need to have a partnership between the private and the public sector. But there are two levels at which that partnership needs to happen. First of all, it has to happen at the national, the aggregate level, because there is a massive funding requirement that's going to be associated, both coming out of the pandemic and the restructuring of those failing firms, but also in terms of the required investment that's going to be needed for leveling up and scaling up businesses outside of the Southeast. And to achieve that, we need to have a provision not just of private capital from financial institutions, but also from the public sector, public provision. And we're going to need to create an institution that's going to be able to provide that funding and to take on board the large number of failing companies that are going to be associated with out of the crisis. That's at the national level. But likewise, we need to have that partnership between the public and the private sector at the local, regional level. Because much of that experimentation, much of that knowledge base is something that will not exist simply at a national level in London. It's something that requires the local knowledge and expertise of both local governments and local companies to be able to solve those local problems. And that's where the financial system has such an important role to play. Because we need to, first of all, create some type of national development bank that will be able to provide that public funding and work alongside private capital markets in providing the financing for business. But we then need to take that combination of public and private finance and translate it from a national capital city, Whitehall, City of London level, down to a local regional level. And we need to be able to translate it from large-scale funding into the financing of companies that are going to be particularly important in this process of experimentation, and that is the small and medium-sized enterprises, precisely what the British financial system has been so bad at doing to date. How are we going to do that? Well, there are a lot of private institutions that can play a very important role in doing that. That's basically what venture capital is about. And so we should be exploiting as far as we can the existing financial institutions and leveraging them to help to create this investment, in particular in small and medium-sized enterprises at a local level. But we're also going to need to have new institutions that are in particular are going to have that engaged involvement in growing businesses, small businesses at a local level, in regions of the country where typically the venture capital financing has been deficient, in the most depressed parts of the country. And to do that, we're going to have to create an institution that will supplement what the private sector can currently provide. Now, fortunately, we have a model of this having been done at one stage during the last 60 odd years, when the government created what was termed the Industrial and Commercial Finance Corporation, ICFC. It came in response to an observation that was made during the interwar period of a serious deficiency in terms of the financing of small and medium-sized enterprises. So what was created was a joint partnership between the banks, the private commercial banks, and the Bank of England. And what was interesting about this institution that was created was it operated at a very local level. And it employed people who had a real understanding, not just about finance, but about business and what it takes to create and grow businesses. And so what ICFC did was to invest at a very local level with patient capital that allowed the small and medium-sized enterprises to really flourish for a period of time, until, unfortunately, as part of the privatization wave that spread through Britain during the 1980s, the Bank of England decided to sell its share in ICFC, and it was then floated as 3i on the stock market in the 1990s. And we lost an institution that was central to helping to promote both regional and small and medium-sized enterprise development in Britain. So that's the element of what we feel are the financial reforms that are required. First of all, the creation of a national development bank. And secondly, the creation of an institution that will link that with investment that will be made at local levels in small and medium-sized enterprises. And at that point, I'll hand over to Paul.
Thanks, Colin. There's a fascinating set of points there. I see there's already 4 questions on this, but I've jotted down 8. But it's not time yet. We have to pause because Paul is the other key part of the double act, and it wouldn't be complete without hearing from you, Paul. Please, the floor's yours.
Okay, thanks. I'll pick up where Colin left. I'll start with, we needed this anyway to achieve levelling up. Much more as a result of the COVID crisis. And so I want to start with 2 effects of the COVID crisis. One is, they're very related. One is disruption, and the other is uncertainty. And the disruption is producing a pattern where some firms really will and should go bankrupt. There's no point in keeping them alive forever as zombie firms. Their business model is no longer going to work for whatever reason. And the other side effect of this is that some businesses, opportunities have increased. So some firms will have to close. And then the vital thing is that the opportunities which have opened up are sniffed out and expanded as rapidly as possible. So fast expansion. For that fast expansion, you need finance. So you need 2 stages. You want the sniffing out of opportunity, which Keynes called animal spirits, and then you need the finance to back that to enable it to scale up. Just to give you an example of what happened in the 19th century, at Easter, I took my kids to York to see the Railway Museum, the National Rail Museum. And it's fascinating because there's 2 museums in one. So the big museum starts with the rocket, the first steam engine ever, 1830. And then you get a century bigger and bigger, more amazing steam engines, culminating in 1930, 100 years later, with a huge monster that was exported to China, by which stage Britain was producing half the world's steam trains and exporting all over the world. And then you go to the other museum and you see how that happened. And it's a museum of models of trades. And all around the country, people, very ordinary people, were trying to figure out how to make something that worked better. First, how did the rocket work? And then how could you make it work better? And these models, once they hit a model that worked, you could then see in the photographs how that model then got scaled up by investors saying, yeah, let's try this. And of course, it took a lot of money to build a factory that could produce these things at their true scale and in volume. And so that's the process that was happening in the 19th century and that took Britain from the rocket to this dominance in a massive industry 100 years later. It was a process of experiment, innovation, and finance to link it. How do we get that back? Well, we need to have people who will sniff out the opportunities, and then other people will back them with money. And who's going to do that? Is it going to be small and medium firms, or is it going to be the big firms? But unfortunately, we know that the big firms are atypically averse to uncertainty, which economics sometimes calls ambiguity. Right? We know that ambiguity aversion kills the willingness to make irreversible commitments. But in recent research, it's been shown that ambiguity aversion is much more severe the more sophisticated the financial actor. It's puzzling. You'd think the presumption was the opposite, that only the idiots were ambiguity averse. And the big companies would be perfectly willing to take risks. It's the opposite. And why? Because the big companies have formalized procedures for decision taking. And those formalized procedures basically mean that there's somebody on the board saying, what are the numbers here? What are the probabilities? Well, the very essence of uncertainty is that there is no answer to what are the probabilities. The probabilities in radical uncertainty are unknowable. And so, inevitably, in formal large companies, somebody's going to say, where are the numbers? And somebody else is going to have to admit there aren't any, or they're made up. Now, small firms don't work like that. It's the small firms that work with animal spirits that Keynes was about. What animal spirits means is some aren't.
Well, we may have just lost Paul there. I'm sure he'll be back in a moment. And while we're waiting for him to come back, let me turn to the questions, because as I said, I had a whole stack of them for Colin. And I just actually point out to those listening in that you can click on the Ask a Question button at the bottom, and you can actually vote particular questions up. I think you can vote them down, which I'm sure some people would find dismaying. But you can vote various questions up. And the question that's been voted at the top of the list is actually, I agree, a very good question. I didn't vote it up, but it is effectively to Colin, which is convenient, given that we don't have Paul anyway. But the question is, how could we define engaged banking, Colin? And if we're to do as you and Paul would suggest, and to rework a 3I, or accept the state and private partnership of it, what are the implications for the skills and competencies of bankers all around the country? And how do we develop those skills and competencies quickly enough so that we don't end up with either massive misallocation of capital, or perhaps bankers getting too cozy with their clients and having semi-corruption sort of issues? How do we, I mean, it's a whole ecosystem that we're building here, and how do we get more engaged banking?
Okay, a great question. And the answer in short is that by engaged banking, one means relationship banking. And by relationship banking, one means a long-term, relationship between banks and their borrowers. Because what distinguishes relationship banking from other types of banking is that the banks prosper and profit from growing with the businesses that they're funding. It's differentiated from transaction banking insofar as transaction banking makes money from selling products. What relationship banking does is to say, well, yes, one's selling products, but really the source of the benefit derives from promoting the long-term development and scaling up of companies. Now, what does it take to do it? The answer is that there is one key factor. Well, there are a number of important factors, but one that is particularly in evidence when one looks around at successful relationship banking systems and banks. And that is that they have people who are employed, who are knowledgeable about not just the elements of financing companies, but the aspects of what it takes to really grow a successful business. It's actually something that is closer to the types of knowledge that the general partners in a private equity business will have, where they routinely will engage in a very close involvement in the companies in which they're investing and provide a very hands-on form of governance of those companies. Now, it's not exactly the same, because what a bank is providing is debt finance as against equity finance that a private equity firm is offering. But this distinction is not that great. And what one then observes is that it's banks that have that expertise on both the financial side and the business side that then are able to create that type of relationship that is not observed in the more transactional banks. And that was the feature of ICFC during its heyday. It's also the feature of what one observes in the relationship banks that are found in, for example, Germany and in some parts of the US. And it's also the feature that one observes in some of the most successful banks in Europe, that they have precisely that type of characteristic.
Very interesting. Now, we had Paul back for a minute, and I don't know whether it was the fact that I didn't ask him a question in that time that we've lost him again, but I'm sure. Oh, here we are.
I'm back again.
He's back again. That is brilliant. Welcome back, Paul. Do you want to finish what you were saying? Otherwise, there's a very nice segue I have from relationship banking from Colin to a question that I think we need to ask you, if that's okay.
Go ahead.
So you spoke several times about sniffing out these opportunities, and I note that we may be joined by your dog at some point during this conversation, so there's not too much sniffing going on in your household. But many of these new opportunities, and I hate to do this to you because it represents my prejudice, many of them will be in the transition to net zero emissions, where we have to effectively rewire a substantial amount of the industrial and economic base. And I put this because there are actually a number of questions in the list around the natural capital side, and one in particular. So the last excellent question from Valerie is matched, I think, by this question from David. Are there lessons to be learned from the Green Investment Bank? And many actually in this arena are calling for a new national infrastructure bank. How does that sit with your call for a new national development bank? And can these two things be married by your proposals for financial levelling up?
Yes, I think they can, because they're both. Here are two national objectives: levelling up and zero emissions, and they're both proper objectives for a national bank. So both can be served by the same institution. There's no problem there. But the key point of this particular business of levelling up is it needs to be locally based financial entity, because only the locally based has the tacit knowledge that can sort out which of these SMEs is onto something good. Most entrepreneurs come up with things that sound good to them, but turn out to be wrong, right? We know that of the jobs generated by SMEs over a 7-year period, half are due to only 6% of the SMEs. Right? So the task of identifying which of these needles in a haystack is going to be the SMEs that are really onto something, that is a very skilled job. It requires a lot of local expertise. And that local expertise is itself subject to economies of scale. So you need a team with expertise that has accumulated over the years so that it knows the local business network, knows who you can trust, who you can't trust. And at the moment, we don't have those firms usually in the regions. The regions are too poor to sustain them. And this is where the COVID opportunity gives you an opportunity to leap straight there. We'll be holding nationally a lot of equity in a lot of SMEs in the regions. Those equity stakes can be bundled up, held by bid out to venture capitalists or to local branches of a new 3I, both a public institution and use the private institutions. And they can leap straight to the scale at which they would be viable. Right? At the moment, the only place where they're viable is London. And so 2/3 of all venture capital is provided only to the southeast. So 2/3 of venture capital is flowing to the southeast. Southeast isn't 2/3 of the economy, it's less than a quarter of the economy. But it'll become 2/3 of the economy if we keep on with a structure where the only SMEs that get finance are the ones that are within reach of London.
Fair enough. Just a very quick follow-up on this question, whether you merge an infrastructure bank or you create an infrastructure bank and a development bank and they're separate, or are they together? I mean, if Bayes or Number 10 were asking you the question, would you be suggesting a single institution to overlook all of things on the grounds that perhaps actually infrastructure decisions are as local as SME sort of decisions? Or would you be saying actually there's quite different skill sets in your very large scale management of infrastructure projects versus picking which businesses are likely to succeed at the startup or seed capital or Series A sort of round?
I mean, Colin will come in a moment on this, but purposes will gradually evolve. I mean, it's not going to be only regional development and levelling up that are going to be of importance in the next half century. And the green economy, it's going to be a variety of purposes. And so it's proper that these purposes should be housed in an institution which can take them on. But let me pass to Colin.
And let's be clear that we will want to create a number of these institutions, partly for the reasons that you're suggesting, Cameron, and that is that there are different functions that institutions and different problems that they should be addressing, but also because we don't want to create a monopoly.
Yeah, we want to
have one large institution operating in this area. We want, again, there to be experimentation in terms of how the institutions function. And so that is going to encourage an element of competition, not excessive competition, but some competition between these institutions.
I think this is one of the approaches that Israel's followed, is competing public institutions that do venture capital, basically.
Well, that's a fascinating suggestion, because my next question, which isn't on the list from those listening in, but do keep bringing them in, is which countries would you hold up as models here? Is it Israel? Is it Germany? Are there other Asian countries? And to the extent that some countries are doing this well, if you just try and plug and play them in the British context, might you end up making mistakes? So what should we learn from experience in other countries here?
Well, there are very good examples of successful financial systems. Germany is frequently cited in this area, but there are indeed elements of the US system which are also very successful. Now, what marks out both of those countries is a high degree of local autonomy of the relevant institutions. In Germany, it's a combination of the savings banks, the Sparkassen, and the Landesbanken. And those two institutions together provide lending that's at a regional and a local level. And they have a mechanism for avoiding what I was describing as being the cause of the decline in local banking in Britain in the 19th century, namely financial failures, by having a system of co-insurance of those local institutions. Likewise, in the US, there's a thriving regional local banking system, partly because of rules preventing interstate lending from occurring. But again, it's backed up by a system that provides an insurance mechanism for avoiding the types of systemic collapses that we observed in the UK. That takes the form of the FDIC in the case of the US. Now, in both those countries, what of course marks them out from the UK is their federal systems. So that by having states or the Landers in the case of Germany, you're able to create a fairly natural way of partitioning banks on a regional basis. But there's no reason at all why we shouldn't, within the context of the UK, create what we have done very successfully already, and that is to find a way of delegating decision-taking so that it operates at a local level, even in the context of a national institution. And there's a very good example of that, which comes, in this case, from Sweden, the bank, the Handelsbanken, which is an international Swedish-owned bank that operates at a very local level, to the extent that the mantra of the bank is the branch is the bank. It's found a way of being able to devolve decision-taking down to the local branches, and it is one of the most successful banks in terms of its financial performance, as well as in terms of promoting the development of small and medium-sized enterprises.
If we compare venture capital in America and Britain, venture capital in America, the typical venture capital entity is much larger. It spends a lot more of its energies on working with firms rather than raising money. And it's much more intimately connected with locally based universities. And so what America's done really well is get the sort of nexus between research in universities, entrepreneurs sniffing out opportunities, and local finance that will back those opportunities. Even so, they have a high rate of failure. That's the nature of the beast. There's so much uncertainty.
Yeah, I don't think anybody's expecting perfection here. In a sense, if you had perfection, you wouldn't be doing it correctly, because you need to have failures in order to be taking appropriate levels of risk. And if you're not, you're clearly not. Can I go back to Colin? If Handelsbank and banks like it are so successful, then why doesn't the market just lead to a bunch of competitors and imitators? Why do we need a massive pandemic and a huge crisis and state intervention to deliver this kind of banking structure if it just works?
Because that's exactly what brought about Handelsbanken's reform in the 1970s. Namely, it faced a crisis, and to overcome that crisis, it recognized it had to change its business model in a fundamental fashion. So the problem that exists in most banks, and in particular in the large commercial banks in Britain, is they're run on a very hierarchical, centralized basis. And that's been an increasing tendency, not a diminishing tendency recently, because of the influence of regulation that's imposed ever serious requirements on the boards of companies to be able to monitor and manage risks throughout their organization. Now, of course, it's impossible for a large international bank to be managed from the center, from the top. But what those banks have been unable to do is to create the type of inversion that Handelsbanken went through, namely to recognize that in terms of shifting from being centralized control It needs a very different model where you're placing trust on people lower down in the organization. You're not simply incentivizing them on the basis of their financial performance. So it needs a philosophy and a management process that shifts the nature of the bank fundamentally from the structures that currently prevail. And we've observed that happening through some processes, such as the rise of private equity, which in many respects replicates that type of process. But we haven't been able to do it within the context of our banking system, not least because of the way in which we regulate our banking.
Okay, so if that's true, then, and I realize I need to get back to the set of questions that are waiting for us, but this is really interesting. If it's true that this is, in a sense, regulation driving the centralization of the financial system, which is then causing these problems, rather than a big state institution being constructed, is it not the case that we need to rethink the regulatory framework and then allow, rather than the center imposing a regional arrangement, allow bottom-up series of Handelsbanken to emerge? Or is that not likely to happen on the timescales, or there's systemic reasons why we just can't expect this from the private sector?
That's entirely appropriate, where the only problem you're trying to solve is essentially the financing of SMEs and other entrepreneurial types of companies. But where there is this additional problem that we're talking about, namely that there's a public-private partnership problem that arises, you have to think about how do you create an institution that has that public focus as well as a pure private focus associated with it. So you have to go beyond the Handelsbanken model to say, we have a particular problem that we're trying to solve in the UK, and that is this massive degree of regional disparity that exists, that is built up in part for the reasons that I was describing, and that needs to be reversed. And that needs a coordinated function between public and private, which requires this type of institution.
Okay, that makes sense. Right, so on the list of questions, the question that has been upvoted the largest number of times, which makes it impossible for me to ignore, even if I wanted to ignore it, which I don't, but is a question about unorthodox economic theories, low growth, degrowth, steady state economics, and stock flow consistent modeling. What do these theories have to tell us? How can they inform us as we are rebuilding and as we're perhaps building this decentralized, regionally based financial system that you're calling for? And there's a green flavor here too, Paul and Colin, whether you like it or not. So how do we operate within a donut, Kate Rayworth donut, or with the concepts of regenerative natural capital? So there you go. It's a small set of concepts there for you to tackle. Colin, as a member of the Natural Capital Committee, would you like to have first bite at that one and give Paul some time to think?
Yeah, and it's very closely related to what we're talking about, because if you think about the natural capital agenda, the way to tackle the natural capital agenda is to think about how one does it at a local as well as a national level, because there are different natural capital issues that arise in relation to urban conurbations in terms of the creation of open spaces, parks, etc., in cities, centres, from what exists in rural parts of the economy. There are different problems in terms of coastal areas from inland areas. So one needs to think about how does one, in essence, create the momentum, the planning, the investment at local levels that are going to successfully fund the growth of these natural capital projects. So that in terms of addressing that problem, we require a similar type of institutional process. And again, notice it's a public-private activity. It's something that needs a coordination between local authorities and landowners, and also with the private sector, with the corporate sector, in terms of being also a large owner of natural assets. So one needs to have that public-private coordination, and one needs to have it properly financed. So it's a very similar type of set of issues.
Fair enough. That makes sense. Now, Paul, can I perhaps ask you to answer the more general unorthodox economic theory bit of this question? I mean, in a sense, there's multiple equilibria everywhere here. But does this really mean that we need to extend our way into heterodox economic theory to justify the sort of thing you're calling for? Or is it all there in the mainstream corpus?
Well, what's heterodox and what's orthodox? I mean, radical uncertainty now seems to me to be so central to the world we live in that it has to be considered orthodox. And it seems to me that the pieties of Chicago in the 1950s really need to be seen as the pretty unorthodox departure, which manifestly came to grief, and the big central implications of radical uncertainty are that first of all, that if you don't know, you better start to find out, and you find out by getting local, because context always matters. I was recently in Trondheim, which is and talked I had dinner with an old local banker. He told me this story. He said Trondheim outcompetes China. Our wage levels are probably 10 times higher than anywhere in China. We're a manufacturing city, and we do it by very, very high skilled labor force, very smart management, a lot of innovation. And I, as an experienced local banker, have to learn which of these entrepreneurial ideas I can afford to back and which I can't. And he said, over the years, I built that local skill, but it is a local skill. And then he says, now I'm subject to the requirements of financial regulation, that every time I want to do a loan, I've got to put it into a risk-weighted model. And quite often, the risk-weighted model says no. I know that it's a good thing, so I just do it. But he says, I notice that the young bankers in my bank, when they think the right thing to do is to back their hunch, which is not just a hunch, it's tacit knowledge that they've accumulated, and they put it into these risk-weighted models and it says no, they daren't trust themselves. And he said, as a result, we're losing the skill, because it's only by trying and failing that you learn. And so even in Trondheim local banks, we're destroying that knowledge because of financial regulation. Just to return to the environmental issues, I wrote a book called The Plundered Planet, which is about natural capital and the importance of getting to a balance sheet approach. And just to bring that back home to what Colin was saying, these are, of course, proper public purposes, but they are public purposes. And they need to be in there in the value system. And that's the public-private partnership. The public needs to be paying the private for verified, quantified environmental asset investments.
Let me take you back just to what you were saying about Trondheim. There's a lovely question here from David Cowell. It's been voted up a number of times about how at 3i back in the day, they spoke of being involved investors. There's not quite, Colin, your terminology of relationship banking rather than transactional banking, but I think they're probably similar things here. And the question is, how many companies can a single investor usefully be involved in? So I don't know how many ventures your Trondheim banker kind of properly understood. And then given the answer to that, how many such investors, venture capitalists, etc., would we need across the country to regenerate the regions and the SMEs? And I mean, I guess implicit in the question is two more questions. How feasible is it to have this cadre of bankers? This is a big job creator. I don't know. Yeah, thoughts on that one?
So the answer is, and you get a sense from this when you look at how engaged institutional investors, private equity firms, hedge fund activists operate. They have very small portfolios. Okay, you contrast those with the big investment management firms with literally thousands of companies in their portfolio, and you understand what it takes to be able to create a relationship engaged form of institutional investment. Now, underpinning your question is, well, is this just a transaction cost that's going to increase the inefficiency of the economy? My response to that would be exactly the opposite, that in many respects, it's the other form of large scale arm's length relationship investment that has been a source of economic inefficiency. It's been very efficient in terms of us as savers, being able to diversify our portfolios at low cost. It's been dreadful in terms of translating those savings into forms of finance that the corporate sector really needs to have. And we've observed that failure at numerous levels, not just in terms of financing, but in terms of the governance of businesses in general. So in terms of the return from an investment along the lines that we're talking about here, they are formidable. Just think about it in terms of what happens if one really succeeds in creating this levelling up agenda by which we bring up the performance of the economy as a whole to the sorts of levels that we're used to in the Southeast. The returns from doing that will be simply phenomenal.
I mean, I'll give you an example of a northern-based venture capital team that about 4 years ago raised £50 million. They invested that in 16 firms. They're following those firms very closely. They have the chair of the board is always appointed by the firm. They are in there monitoring week by week, month by month, especially during COVID. They want to know where they need to lend money to keep those firms going, which ones should they pull the plug on. And what they aim to do, they'll be holding for about a decade, and they aim to double or treble over the course of that decade, which is perfectly feasible. These are the processes by which you pick the 6% of SMEs that have really got promise. But it's very labor intensive. That's why you need these clusters of expertise, and a portfolio of 50 million isn't enough. This is where the venture capital teams in the US have got much more scale and spend much less of their time trying to raise money.
So on this point, and very neatly related, again, a nice question from Alex Miller about just how long might it take to develop all of this local knowledge, this in-depth relationships. It's going to take a while, isn't it? And the problems that we're facing are fairly urgent. And if you're in number 10, you need these regional disparities to be sorted by the next election.
So the answer is that yes, the whole of the levelling up agenda is, of course, a long-term program. This is not something that's going to be done within a year or 2 years. But to come back to the illustration of the institution that was created, namely ICFC, that got going and expanded within a matter of a few years after its formation, and it was almost successful straight away because it was meeting such an obvious need that arose in terms of the financing of business. Exactly the same thing arises here. And let's be clear that in terms of the way in which one can bring this about, one can do a lot with existing private institutions. So let's come back to the example of venture capital firms or private equity firms more generally, that basically they are money machines. Okay? They look to create substantial returns for the investors over a period of about 5 years or so. What's needed in terms of really aligning them better with the levelling up agenda and the regional inequalities is to say, well, yes, they need to generate a return, but we also want to combine that with a delivery of these public functions as well. So by having this national development bank investing in these private institutions, we encourage them to shift their focus in a direction which is more productive for the UK economy, while at the same time retaining their ability to be able to turn around companies rapidly over a relatively short period. So there's a great deal that one can do in terms of reforming the private sector at the same time as one's building up the more publicly focused institutions.
We've got a huge financial sector with a huge number of people skilled in it. They're just all in London. COVID is an excellent opportunity to move a lot of those guys out of London back to where they came from. Many of them would like to go.
Yeah, the sense that you should all go back to where you came from is a line that I prefer not to use in many contexts, but perhaps it's more appealing and entirely appropriate here. Okay, interesting. So you're starting to, I mean, I'm trying to be as skeptical as possible here,
Sure.
and I'm failing really because you're persuading me of the merits of these positions. Let me just pick up on a couple of other questions that we're running out of time too, but there's a couple around the financing of such a new institution. You know, can we print a whole lot of money, and do we need to worry about inflation to finance it? Can we, can we use modern monetary theory? Are there, what was the other? There's another. Oh yeah, should we establish a sovereign wealth fund? And obviously, ideally, the best time to establish a sovereign wealth fund was 30 years ago, when we had the North Sea oil. But we don't have that. So should we do that? We still have a bit left. So perhaps just some thoughts on how this fits into the macro context and how you might finance and establish those flows for the institution.
Well, of course, we've done a lot of this already in terms of the bailing out in the COVID pandemic. We've increased our borrowing requirements substantially. There's been support from the Bank of England in terms of the monetary response. And there is clearly one element that plays very much in our favor in this regard, and that is the remarkably low real rates of interest at which governments can borrow. And so it so happens that currently the opportunity in terms of raising capital at low cost and investing it in very productive ways is better now than it's probably been at any stage during the post-Second World War period. But it's critical that really does yield productive returns. Now, the risk, of course, in terms of the public sector raising large amounts of finances, it doesn't go to truly productive investments. And that's why it's critical that this national institution is combined with a financial institution and financial institutions that translate it from being public funding into private investment. And that combination is the way in which we believe that not only do you borrow at remarkably low costs of capital, you turn it into seriously positive rates of return.
Yeah, I mean, the fall in aggregate willingness to invest relative to save and the increase in willingness to save are all sort of responses to this radical uncertainty and the ambiguity aversion of not wanting to commit. But somebody has to commit. We have to translate those savings into investment, but there has to be as well-informed investment as possible. And in the present context, where we just don't know what the opportunities will be, investing heavily in the knowledge that sniffs it out, that is the best we can do.
There's so much sniffing going on in this conversation, Paul, that I'm awaiting the emergence of your dog.
He's sitting quietly and patiently next to me, waiting for his little little moment, and I'm sure it'll happen.
Well, we've only got 4 minutes, so it better be soon. So, and speaking of time, there's basically one more question that I really want to get in, and this is my own. So, apologies to those of you listening whose questions didn't get asked. You know what you're proposing better than anybody. You've thought about it harder. You're probably in a best position to say what might go wrong. So you've painted a very attractive picture here. This is a new model of national financing. It's devolved. It leads to regional equality. It leads to better information, better investments. It can happen reasonably quickly. We've got to do something like it anyway. But suppose we do exactly as you asked, and you fast forward 10 years or 20 years. What would your fear be? How would it go wrong?
Oh, you stop.
I'll have a go here. My fear is that nothing else is done. Because finance, locally based finance, is just one of a series of complementary measures which are needed to make levelling up work. Painful to say, but our universities need to do a better job at actually doing research which helps local firms get to and keep on the knowledge frontier. The sort of to give you the most concrete example I can think of, the most obvious equivalent of the MIT Harvard hub in Britain would be a link between Oxford and Cambridge. And there's been a Whitehall plan, the Ox-Ex-Cam corridor. It's been a plan for 5 years. It's a no-brainer, right? As you know very well, Cameron, the getting between Oxford and Cambridge is so awful that a local entrepreneur tried even to do an airlink, to do an airline. And yet in that 5 years, nothing has happened because local government is such a mess. There are 22 local governments between Oxford and Cambridge, and there is no mechanism yet for coordinating them. So that's one of the things that has to happen. Skills. We've not talked about skills. Britain is brilliant at producing PPE degrees, but that's not enough. We need very good vocational training. The OECD model for how to do that is Switzerland. 200 courses, 3 to 4 years each course. Britain is a chaotic system of vocational training, low status, 700 different courses, all of them short. It's a mess. And so there's a lot of things that need to be done in a complementary fashion.
Well, it's a point very well made. This is required and important, but it's not sufficient, and it won't do it by itself. Colin, we've got a minute left. Did you want to add anything to that? Well, what could go wrong? What's the big fear?
That not only will the other things that Paul talked about not happen, that what we've just talked about won't happen. Namely, the government will say, oh, we don't want to have an institution where we're holding equity in the private sector, or that we think that there are already existing institutions that do what you're talking about, like the British Business Bank. And the answer to those points is that no, we don't have an existing institution. And secondly, this is not about the government simply taking on equity in the corporate sector. It's about providing the risk-taking type financing that the corporate sector really needs, and then using the private sector to make sure it happens. So my concern is what we're putting forward won't happen either.
Well, look, what a great pleasure it's been. I can barely believe that was an hour, but I've learnt from you, as I always do whenever I speak to you both. And I'm sure those listening in have done so as well. And I can only hope that you're right, or that your fears aren't met, and what is a 100-year-old problem that we've already solved once isn't something that we can't solve again. So thanks for the work you're doing. Thanks for the paper in the Oxford Review of Economic Policy, and thanks for joining us at the Oxford Martin School as well. Now, for those of you tuning in, the next of these conversations is at the same time next week, Tuesday, the 28th of July, and it's with Professor David Vines, who will talk about global macroeconomic cooperation in response to the pandemic. So it remains for me to thank Colin, thank you, Paul, and thank you all of you listening in and asking questions and voting them up and down. Great fun for me, but I think we managed to get most of them in. So thanks very much, and we'll join you next week. Goodbye.